Want a cleaner way to trade views on inflation, interest rates, or earnings risk? Here's how regulated prediction markets turn big economic questions into precise, tradable probabilities. Investors often face blunt tools. Stocks, bonds, and options can reflect a view, but they bundle many risks at once. When the real question is whether next month's inflation runs hot or if the Fed holds rates, indirect exposure can muddy the signal and the hedge. Kalshi's co-founder Luana Lopes Lara argues that event contracts fill this gap. Instead of owning assets, you buy a yes or no contract on a specific verifiable outcome. Each contract pays $1 if the event happens exactly as defined and $0 if it doesn't. Prices trade between 1 and 99 cents, so the quote is the market-implied probability in real time. A 63-cent yes suggests a 63% market view that the outcome occurs. The first insight is regulatory design. Kalshi chose to build as a fully regulated U.S. exchange. That slowed the timeline and raised compliance costs, but it aimed to earn trust from both retail and institutions. Clear rulebooks and oversight matter when settlement depends on a definition down to the decimal. The second insight is measurability. Contracts focus on outcomes with transparent data sources, like CPI prints, jobs figures, or policy decisions. That reduces ambiguity at settlement and helps traders map contracts directly to macro exposures that move stocks, ETFs, crypto sentiment, and earnings expectations. The third insight is portfolio fit. Event contracts can isolate a single risk, say whether CPI exceeds a threshold, without taking a position in a company or duration. That can complement equities, options, or ETFs. You can hedge a potential earnings surprise by taking a view on the macro input that might drive it, or express conviction on the next rate decision without embedding sector or balance sheet risk. The fourth insight is discipline. Standardized terms and precise criteria aim to make results verifiable. That structure lets probabilities update continuously as new data hits, giving investors a cleaner read on consensus and shifts in sentiment. The practical takeaway: if your portfolio decisions hinge on a specific, measurable outcome, consider whether an event contract offers a more direct expression or hedge than a proxy trade. Know the settlement rules. Treat the price as a probability. Size positions prudently, and remember that outcomes are binary even when probabilities aren't. Want to go deeper on risk, regulation, and how these markets intersect with stocks and rates? Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.